While the Fed can print money to buy gold, and that drives the gold price higher, not so in silver. There simply isn't enough silver for the LPMCL to even source. It just simply isn't there. No matter how many dollars you print, you simply cannot buy the bullion. We're talking a huge amount of a short position that is impossible to cover. Hence, the realization that to bring sufficient silver to market to actually meet this forced short covering demand is going to require a minimum of $80 an ounce.
Over the past weeks, silver has moved from the margins of investor attention to the center of a structural market story. And that changing landscape is precisely what Andrew Maguire is analyzing in his latest interview. The spot market is signaling acute tightness. Spot silver has rallied materially, and trading levels observed this month sit meaningfully higher than the lows of October, reflecting both renewed investor accumulation and near-term delivery stress in futures markets. This price action is not simply a short squeeze headline. It is the market responding to an observable and growing imbalance between physical offtake and available deliverable metal. Maguire frames the situation as a supply-side crisis that the paper market can no longer paper over. He points to record-depth backwardations, extraordinary delivery notices, and the inability of large counterparties to source physical metal as the proximate mechanics that will force a major repricing. Where paper leverage once masked tightness, the combination of exchange delivery demands and export controls in key physical markets has exposed that paper and physical are no longer fungible in the way many market participants assumed. These are not academic differences. They are the plumbing of the market, and when plumbing breaks, the price signal becomes sharp and immediate. Central to Maguire's thesis is the scale of the short position he describes and the physical scarcity that underpins it. He argues that the volume of naked short exposure in silver has become sufficiently large that meeting forced delivery demand would require a very substantial revaluation of the metal. His working floor for that revaluation is in the region of $80 per ounce. He does not present that figure as a speculative outlier, but as a consequence of a physics of supply calculation. When contracts must be met in metal rather than paper, absent a rapid and large increase in available bullion, the only mechanism to equilibrate market clearing is price. The recent reporting of persistent backwardations and heavy month-to-date delivery notices lends empirical weight to that mechanism. In today's video, Maguire walks us through specific delivery numbers, the timing of BIS-squared events, and where he expects options compression to break price support. Stick around because he properly dissects those mechanics and show why. From a structural perspective, this is not a routine commodity rally, but a regime shift in how silver clears and prices. If you find the analysis valuable, please like and subscribe. It helps get this factual, market-first perspective to other investors who need it. We appreciate the support and hope you enjoy the video.
Today is kind of the first notice day, even though it's a day early. So we would expect the next major rally point to commence after today's first notice. Now, there is going to be a Bank of International Settlements squaring event on Friday, which is a very shortened session. You know what? I think they're going to have a tough time each and every month we've seen higher and higher and higher place for the Fed to square what they've borrowed from the Bank of International Settlements at the end of each month, the mark to market, they call it the BIS event, and it'll be higher. So likely, as I say, most traders are now required to fully fund December contracts or roll these positions which would be the February contract would be the next most liquid contract for gold. But given the unprecedented backwardations into this largest delivery month of the year, liquidity providers are anticipating the rally to begin to get traction directly after the Bank of International Settlements leases get marked to market on Friday, if not earlier. Now, last week's synthetically driven options compression, the derivative compression, where you have this huge amount of billions of dollars worth of paper contracts that have to get marked to market. So the insiders have suppressed the price just to simply get it to that point where they can mark it to market and then run for cover. That went up to a $7.65 backwardation to spot. Unheard of, so close to first notice. Then last Friday's backwardations, we saw a low of the day in futures of 4,018 when spot was 4,022.50. Just to illustrate, this is the spot market evidencing a $4.40 backwardation, even so close, revealing an arbitrable discount was being alchemized into officials scrambling to cap underwater option sweet spots. Now, while the same paper to physical modus operandi applies to silver futures versus spot, it's just silver's not T+1 Basel III compliant. However, with global physically deliverable silver being price being determined outside of the legacy LBMA CME ring fence, the LPMCL, physical market shortages and export controls are exacerbating supply constraints, have driven the silver to spot basis spread into even larger, unprecedentedly deep arbitrable backwardations. Now, last Friday, spot gold fixed, not just intraday, fixed at a 56 cents premium to silver futures. And it went as high as 60 cents, $3,000 per contract backwardation to spot. Now, come on. Why would that not get people's attention? It illustrates there was and is no LPMCL cartel supply to meet demand. They are wrong-footed. And given supply constraints exacerbated by export controls, liquidity providers assess this time around there will be little to any reverse arbitrage shipping of SGEI silver into London. So whereas last time we saw these big spreads and we saw bullion being shipped out from the US into London, Shanghai International Exchange to London, it's not happening. It's just not happening. There's the odd trader that's doing it, but no, it's not happening. No one's trusting this. These deeply backwardated conditions should not exist into a first notice event where 96% leveraged paper contracts have to be cash settled. They have to be fully funded for delivery, or you have to stand to deliver or deliver, or you're going to have to quickly roll them out to another, defer the issue and roll it out to a paper contract further out. But given such tight supply, it's as plain as day. These contracts are mispriced, and someone very big is about to take a very big hit, big enough to need a bailout. And following over 600 tons of COMEX deliveries so far this month in silver, there's still 2,000, as of today, as of last night, there's still 2,128 tons of silver warrants still outstanding. Not silver warrants. It's simply not there. Liquidity providers report very large SLV and backdoor COMEX loadouts are being accrued. This exchange for physical compression has coiled silver for a very large catch-up rally, further compounded by an upside rinse of fresh momentum short additions. Now, the silver and related 4 billion SLV naked short position has become the LPMCL's Achilles heel. Now, we'd forewarned that there would be some derivative options capping at $50 into strong spot silver demand, which is exactly what drove backwardations by up to $3,000 per contract. Now, we continue to expect capping into BIS squaring resistance at maybe 52, something like that, perhaps 53. I mean, we're already, looking at the charts here, 52.5 I mean, I would have said 55, but I think they're going to try and keep this capped a little bit because silver heavily influences gold and they really want to square these. But the point that I'm also trying to make is that the Fed has really misstepped here because the OCC bets, as we'll just look at, the OCC bets, FX bets against unallocated silver. They don't have any silver at all to meet this demand. So what we're saying is, though, silver is quilling for a physically settled rally spring, is what we're saying.
In the interview, Maguire explains that a lot of the recent price action started with pressure inside the options market. Traders were forced to mark their positions to market, and some big players tried to push prices down during the day to limit their losses. But once that pressure eased, the physical side of the market took over, and that's where things got serious. When the paper side of silver stops holding prices down, the market has to deal with the real question: how much actual metal is available right now? And when inventories are already low, that adjustment isn't gentle. Rallies can start during these delivery windows and then speed up quickly as big players either pay up for physical silver or choose to stand for delivery. Both choices push prices higher. Maguire also points to what's happening globally. Asian markets, especially China, are pulling more and more physical silver out of Western vaults. At the same time, exchange-traded products and long-term investors have taken a lot of metal off the table. Industrial demand hasn't slowed either. So you have a world where more silver is being used, less is available for delivery, and new supply from mining isn't growing fast enough to fill the gap. In that kind of environment, any squeeze or delivery stress isn't just a short-term price spike. It becomes a real market event. That's why Maguire says $80 silver isn't a wild prediction. It's a number that makes sense when physical demand, low inventories, and heavy short positions all collide.
Now, we've been month after month drawing attention to the Office of the Comptroller report, where the quarterly report really started to illustrate that every single bullion bank that had been short gold and silver had removed their 5-year and further out bets short. And that was telling us they were scrambling to short cover. Now, bearing in mind that these bets, these OCC bets in gold, they can essentially, there's enough gold to actually for the BIS, the Fed, to repay their BIS bets sequentially higher and higher and higher. And it looks like once again going to end up into Friday. And we would expect a little bit of capping into the shortened Friday session as they try and close this BIS bets without getting any further deeper in the hole. But essentially, the Fed have to repay these Bank of International Settlements bets. Now, a lot of this liquidity lives in the Office of the Comptroller bets, which are really unallocated FX gold and silver bets. Now, while the Fed can print money to buy gold, and that drives the gold price higher, not so in silver. There simply isn't enough silver for the LPMCL to even source. It just simply isn't there. No matter how many dollars you print, you simply cannot buy the bullion. We're talking a huge amount of a short position that is impossible to cover. Hence, the realization that to bring sufficient silver to market to actually meet this forced short covering demand is going to require a minimum of $80 an ounce. This is a huge misstep by the Fed. And with the Fed, their agent LPMCL, the 4 banks that have really managed to contain and act on behalf of them in silver, the liquidity, as demonstrated by backwardations, the liquidity has fractured. It's just not there anymore. Also, following 39 tons of COMEX gold deliveries so far already taken out of the vaults, net of rollovers into the February contract, there's still 128 tons of gold warrants still open. And liquidity providers expect large forced EFP deliveries. So let's take a quick look at some other supporting information that is of interest. UPS also continues to raise its 2026 forecast, 4,900, in sync with Goldman Sachs, JP Morgan, alongside almost every other bullion bank, looking at plus or minus $5,000 an ounce into 2026. We've looked at higher, but this is important information that's just really starting to put the naysayers in the rearview mirror. We've also got this Financial Times. And while we've been tracking the process of Beijing's secret monetary gold purchases, where we are not the only ones now assessing these aggregations are much closer to 80,000 tons as well, it's dawning on the mainstream media that assess China's unreported gold purchases could be more than 10 times its official figures. They're grossly underestimating this. This does not come close to capturing military gold purchases which are secret and literally hundreds of tons a year that escaped customs reporting. Beijing's happy with this. They've taken the gloves off. A rising gold price enables Beijing to challenge Trump and the dollar and is a primary reason that gold's share of global reserves on a balance sheet has significantly surpassed US Treasuries. We looked at it last time, the type before. Now, while also acknowledged by mainstream media, gold's role as the only high-quality liquid asset, zero counterparty risk investment asset, is grossly underestimated. This ECB post here is also it's beginning to dawn on Western commentators that the Bank of International sanctioned BRICS payment systems are one by one usurping SWIFT. This on the same week that the Bank of International Settlements backed Enbridge to BRICS trades were stealthily retested. Deutsche Bank, they report on inelastic gold demand, acknowledging that gold's demand is not just focused on a rising price in dollars, alongside long-standing evidence that central banks and sovereigns are diversifying fiat. In other words, they're just getting rid of their fiat into tons of physical gold. They're dumping their fiat into physical gold, regardless of a rising or a falling gold price. Deutsche Bank draws attention to their institutional clients who are also focused on accruing gold ounces. This feeds into the very sticky ETF demand that we've been drawing attention to, that is really forcing the insiders to short cover sold positions without anyone to rinse them into. Now, these are just a very few of many other bullish drivers at play. And the only question I have for you now is really, honestly, how much physical gold and silver do you own now before we look back at this opportunity window to take what is on offer while it's still on offer and to protect our wealth? That window is going to close soon.
The first thing to understand is that silver's recent backwardation, where the spot price is higher than the futures price, is a real warning sign. It tells us that people want the metal right now, not months from now, and that available supply in the near term is tight. When this gap shows up and refuses to disappear, it usually means the market is struggling to find enough physical silver to meet demand. In those situations, price doesn't move slowly. It jumps. The second point is about who is on the other side of the trade. A few big players hold very large short positions in silver. Under normal conditions, those shorts can be rolled over or hedged without drama because the market has plenty of metal. But when inventories shrink, hedging becomes difficult and expensive. If those large players are forced to close their shorts during a period of tight supply, they may have to buy back silver at much higher prices. That's the kind of situation where $80 silver stops sounding extreme and starts sounding like the market simply adjusting to reality. Another thing worth thinking about is how authorities and exchanges might respond if the pressure becomes too much. When big market structures begin to crack, when there's stress in settlement or delivery, exchanges often step in with rule changes, pauses, or new position limits. None of that prevents higher prices, but it can change how quickly those prices show up. Everyday investors should be aware that in a stressed market, the rules can shift suddenly, so having a plan for both physical and paper positions is essential. Finally, silver today is being pulled from two directions at once. Industry needs more of it for technology and energy applications, while investors are buying it as a safe haven. When you combine strong industrial demand with tightening supply and a crowded short market, you get a setup where even a small shock can create a big move. For everyday investors, the takeaway is simple. Understand what you own, know where it is stored, and be clear about whether you're holding silver as insurance or as a short-term trade. In moments like this, clarity and preparation matter more than predictions. Drop a comment with your view. Do you see the present delivery mechanics as a temporary dislocation or the start of a structural repricing? If you found this breakdown useful, please like the video and subscribe for more evidence-led analysis of the precious metals market. Thank you for watching, and don't forget to check out our other videos.